All right, welcome back. So, um, let's talk about some tax planning stuff. Given it's the season, I figured I'm putting in so much time helping my clients plan for the coming year and for saving on taxes for this year. I figure I might as well get some information out to the bros as well. This is not going to be fun to talk about. Just want to say at the beginning that we're going through some reg stuff. I did a video last year titled "Why You Want to Ask Santa for Monero for Christmas," and we went through some upcoming regs for this year that dealt with like the Bank Secrecy Act, and we're going to go back through the 1099 DA again. There have been some changes that I didn't know about. They're actually like decent changes. At first, they wanted wallet IDs. They wanted to know where the crypto is coming from if you're going to deposit it onto an exchange. They wanted to know the wallet address of that source. They wanted the transaction ID. They wanted the date and time of the transactions, presumably so that they can do timing analysis. And if you're not too educated on timing analysis, check out Zeno's YouTube channel. He does a lot of stuff on timing analysis because timing analysis is sort of like the Achilles heel of privacy tech in crypto. And if you're not careful about being mindful of your timing when it comes to doing certain transactions, especially when you're dealing with third party exchanges, even if you're using a privacy coin, that could expose you to certain OPSEC vulnerabilities. So that's kind of interesting to note. But the new 1099 DA does not have those features on it, from what I could tell. And that new version came out a couple of weeks ago. I made a post on my Twitter, I guess probably freaking people out that all this stuff was going to be on the new 1099 DA. Some gentleman out there informed me that that is not correct. So there is a new 1099 DA that came out December 5th. So forgive me for missing this. And it does not have those features on there. Let me see if I can blow this up. I don't know if you all can see that, but that is your account number at the exchange. I'm not sure what a QSIP number is, but it doesn't have those features on there. And just so that you understand, I did get this video from somewhere or this picture from somewhere online that said that this was the upcoming 1099 DA. So forgive me, it was not the most recent. But if you look at this, it kind of shows their hand and what information they want. They want a lot of information. They want your digital asset address. They want your transfer in transaction ID number. So when you go to deposit it into an exchange, they want to know the ID for that so that they can look it up on the Block Explorer, presumably. The transfer in digital asset address, how much is transferred. They wanted to know all that stuff at first, okay, which is quite a lot of information. But that isn't on the new 1099 DA, okay? But it's still nevertheless coming. And the 1099 DA is rolling out in tandem with a change in the accounting methods for crypto, which is going to make things a little bit more complicated. We'll go through that today. But first, I want to direct you to my XMR page, my tip page. If y'all want to leave tips, Fiat Demise, shouts out to you. I actually realized that we have a mutual friend, and IRL in real life, we actually kind of are one person away from each other. You might know who this person is. I believe he hangs out with you, according to him. Now, if you're not aware of this, then I hope you don't think I'm a Fed. Not following you, but yeah, he's actually an associate of mine. I'll put it that way. I don't want to expose anyone's privacy. That probably makes me sound even more Fed-like, but I swear. So I feel like I know you now. I've seen you on Twitter for years. It's crazy that we have a mutual, but you had said and left a nice tip. Thank you. Did you see the debate between Bitcoin Maxi, Guy Swan, and hijacking Bitcoin co-author Steve Patterson? It was on Liberty Lockdown. So I did see that debate. When I get to the end of the video, I'll talk a little bit more about my thoughts on that. It was very informative. I encourage other people to check it out. I would love your take on it. By the way, please update your tip page with content links. And I did take you up on that. I did put the content links in my tip page. I got my Twitter, got my YouTube. That's all I got. I don't think you can put Odyssey on there yet. But I do have a suggestion for the people who are working on this page. If you could Um, because there was, let's see, there's this little thing down here where you can do tip amount suggestions. I thought this is like sort of like Patreon, where you could like put a standard amount there if somebody wants a certain thing. So I put right here custom video topic of choice. So if somebody wants me to make a video on something, I set it to $50 in Monero. Now, when I hit continue, if I go back to my tip page, it just kind of shows up here and like there's nothing that says what that $50 is for. So I don't know if that's something that could be updated to kind of convey what that $50 is. Because I don't want that just kind of chilling there with the presumption that, hey, if you don't got $50, don't tip. You know what I mean? So, um, of course, I want anybody and everyone to tip. And if you have comments or questions you want me to speak about on my videos, you can go ahead and leave a tip like Fiat Demise and all these other bros down here. So, anyways, I just thought I'd point that out. Link will be below. But let's talk about this new accounting method, okay? Because this had some people freaked out. I'll go ahead and read my tweet on this so that you can get the general overview, and then we'll discuss. And I would say I would go through the comments on my tweet here, but pretty much everyone's saying, yeah, I'm just going to not do this. I have a certain sample size of people in my listening audience who are not big fans of taxation. Okay, so I get it. But I can't publicly advocate online you do that. But let's read this. New IRS regs are on the way for crypto, complicating crypto reporting even further. Essentially, before 2025 begins, the IRS wants crypto holders to allocate their cumulative cost basis of the crypto amongst designated wallets. Okay, so that's key. Keep that with you here for a sec. They're requesting this in anticipation of a new accounting method which mandates that gains or losses on crypto is calculated independently in distinct wallets. So the way it was before, and I'm sure a lot of you are aware of this, but before it did not matter where the crypto was. Okay. You buy crypto in 2014, you go to buy more crypto in 2017, you buy more crypto in 2020, and then you sell crypto in 2023. Your basis, no matter where you sent that crypto, what wallets, is first in, first out. So you're selling the basis of your 2014 crypto as the first crypto that you're selling in 2024 if you were to sell it this year. And then you sell it 2017, then you sell it 2020. It kind of goes like that. I'll get the paint out here in a sec just to kind of demonstrate visually. But it was assumed that you had sort of a giant pool of crypto that functioned as one wallet, and your gains and losses would be calculated through the FIFO method, which is actually like an inventory method, but for crypto. So if you bought one Bitcoin in 2014, and then you bought, one Bitcoin in 2017, let's say you sell a Bitcoin and a half in 2024, the cost basis would be that one Bitcoin in 2014 and then half of the Bitcoin that you bought in 2017. That would be the cost basis. And then you'd have a little bit of unused basis. We'll get into that too here in a sec. But that would be the cost basis for your sale. That's how it is now with the universal basis, universal accounting for digital assets method. Okay, so that concludes. Moving on, this rule is rolling out in tandem with a new tax form called 1099-DA. We talked about that. As we anticipated, they're going to make the administrative burden on using cryptocurrency as currency ever difficult. They're effectively discouraging self-custody and privacy with these kinds of regulations. I don't necessarily endorse these, but many are generally advising, from what I've read, to do three things: consolidate all digital assets into one wallet, ideally an exchange, because exchanges are going to be uh, who you outsource to. This is the presumption for your tax compliance, because if you have self-hosted wallets and you're keeping tabs on your wallets, you don't have your crypto on a centralized exchange, then the burden is on you to do the accurate reporting of those wallets. And I imagine moving forward, and I know a lot of you are not going to want to hear this, but if you identify to the IRS that you're dealing with crypto and you don't have 1099-DA forms filed on you, but you do have crypto activity that you're reporting on your tax return, that may serve as a red flag, right? Because they probably trust the calculations taking place by a third party exchange rather than your calculations. And if you get audited, it's up to you to prove your positions on tax. Okay. Now, we haven't really seen this happen yet, although we have seen it in a couple cases where they go after people for taxes on crypto um, based on blockchain forensics. Okay. Usually, when they're going after people for taxes on crypto, it's for 1099s that they had received from the exchanges. And these are more so like 1099Bs, not necessarily 1099DAs, which are coming up here, but there are 1099s which are filed by these exchanges. Um, Based on those 1099s, they go after people because whatever they report on their Schedule D of their tax return for their gains and losses doesn't match up with that 1099, and then you get a matching letter. Okay, so that's in most cases what people deal with when they're dealing with the IRS. Although we have seen a couple cases, like with Roman Sterlingoff and with Roger Ver, where they did do blockchain forensics in order to look at the blockchain and estimate an unpaid liability. Okay, and if they start to do that more and more, which we anticipate because they're starting to integrate uh, artificial intelligence and blockchain forensics into their tool set for going after people with unpaid liabilities, then that could be something which is concerning. That could be something uh, that you may have to deal with if you're not somebody who is using these centralized exchanges to outsource your tax compliance. Okay. So that's something to kind of be aware of, right? So they're suggesting you consolidate all your digital assets into one wallet, ideally an exchange, to outsource compliance and to simplify tax compliance. I've seen reports suggest you may be asked for your cost basis on the crypto you're depositing. So, because these exchanges want to be sure that they're calculating things properly, they may ask you for your cost basis when you deposit your crypto onto the exchange so that they can fill out that DA form accurately. Okay, that's something to look for. And if you don't know your basis, you may be caught flat footed. You may be like, what are they even talking about? So that's what they're talking about. They're trying to prep for this new reporting regime. Number two, buy crypto tax reporting software to keep tabs on your crypto activity and calculate your gains and losses. Now, this is what a lot of people who have self custody wallets are going to opt to do. But then again, you have to have a third party watching everything you're doing with your crypto. That's obviously not ideal. Now, maybe you're a Monero bro and you can't afford your own personal accountant who can kind of track all this stuff because you give them the view key and then they're locking all this stuff manually. But still, you have to outsource that to somebody. That's extra compliance. It's extra work for trying to use this as an actual cryptocurrency, right? And then number three, liquidate all crypto before January 1st to reset basis and track diligently from that point in accordance with the new accounting method. Okay, so basically what you do is you just send all your crypto to the exchange, sell it all, and then buy it back. Pay your taxes basically on all of your crypto that you've accumulated so far, and then just reset your basis by buying the crypto all over again. Okay, so that's another suggestion. That seems more extreme. I certainly wouldn't do that, but that's what they're saying. These new regulations will result in more exchange power and centralization, less privacy, and more overhead for those who want to use crypto legally as a currency. Uh, the walls are closing in. And so some of these are funny, right? This guy asks, how do they track all these wallets? Uh, Ragnarok, you say AI. I agree. I don't know about you, but I have way too many wallets, bro. If you have, bro, you have 50 wallets. Okay, so let's talk about this. Because if you have to keep track of your basis wallet by wallet, which is the new method, then you're going to have to keep track of basis on 50 wallets, bro. See, that's what I'm talking about. That's why this is going to be a problem. Um, 50 wallets. And what's another question I have is if you're using mixers, right? And you're on Bitcoin Cash or you're on Bitcoin and you're trying to send your crypto to different wallets so that you can delink, the history. Do those wallets then become wallets that you have to track basis in? Because um, that's just a question I have. See, you see how this gets kind of messy, right? Because they're trying to pin people down to have certain wallets that they're doing the reporting on. And do they identify a wallet with an address? because you can have one wallet, but you can have many addresses for that wallet. And maybe that's why they took the address part off of the 1099 DA, because somebody informed them that, hey, somebody could have the same wallet, but they could change their address on the wallet, and it's the same wallet, and that wouldn't change the cost basis. So that maybe that would cause confusion if you had to report the addresses. So just again, this is going to be kind of interesting to see how this works. The ledger is fully transparent. Indeed, it is, especially if you're using exchanges. Yep. If you ever bought crypto digital USD, then they have your name tethered to your crypto wallet ID because there's no privacy in any financial banking data. You're still anonymous for now if you bought crypto directly with somebody, IRL and hard cash. It's the only way. Yeah. Well, I mean, Havana is going to be a big deal, obviously. Let's see. I don't think they're monitoring wallets, bro. Of course they're monitoring wallets. I really don't think people are aware of just how much they're monitoring out there. They're monitoring a lot. So those are some interesting comments. Let's see what else. Yeah, a lot of people are saying this is the breaking point where you have the two realms of crypto kind of designate themselves, where you have the solar punk and the lunar punk. The lunar punk, you have all these transparent crypto blockchains, and everything's being complied with, everything's being reported on, everything's being tracked, everything's being taxed. And then you have the lunar punk side where everything is just totally underground. So those seem to be the two worlds opening up, as some people are saying. This guy says they can't arrest everybody. The IRS needs reform. Somebody says, well, they've been rolling this kind of regulation back in China and Russia. I haven't heard about that. I mean, they're not outright banning it, but they still are integrating it into a control grid. Duh. They're still tracking it and taxing it. Good. This is the catalyst that would push people to start using crypto for real as a medium of exchange rather than just another speculative asset. Well, quite the opposite, actually. Um, no, because if you're going to be taxed on every single transaction you make, and all that can be tracked, then people are not going to want to use those cryptocurrencies as mediums of exchange because the reporting is going to be burdensome. You'd much rather use Zelle, or you'd much rather use dollars and just use PayPal, or just use Cash App or something like that. That's going to be the position of a lot of people, or stablecoins. And it's unfortunate that our space hasn't figured out a private stablecoin yet, because that would be really nice to have to avoid the reporting requirements. Um, but no, it's not going to make it easier. In fact, in the medium exchange world, that's why Monero is going to continuously take over. Okay, and I'm not advising people to evade taxes. I never do. But if people want to use currency like cryptocurrency, if they want to use this for what it's originally intended to be used for, without the overburdening regulations, I mean, you all can put two and two together. It's not that hard. The IRS can kiss our ass. Somebody saying I'm not going to have a job in a decade. Obviously will. Let's see. Yeah, lots of interesting comments, but yeah, people are freaking out. Yep, yep, yep. So let's get into the deets a little bit behind this, okay? So this is called Revenue Procedure 2024-28, this new accounting method. So essentially now you have to use basis in accordance with the wallets. Now, you can do an allocation, okay, before 12/31, before the new year starts, in order to establish your basis in these new wallets. And you have to understand something. And forgive me if I went through this earlier in this video, but uh, this is people's opportunity in the IRS perspective to come clean about their crypto. The reason they're calling this a safe harbor is because it's basically an opportunity to say, okay, we understand a lot of you have not been tracking your crypto very well. We understand a lot of you have no idea what your basis in anything is. But if you want to do a reasonable allocation to designated wallets, and then you want to start tracking basis from that point, then you are more than free to do that. You have to justify it, you have to back it up, and they have methods down here where you can do the specific allocation method where you allocate unused basis to either a pool, blah, 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 or the global allocation method. You could read all about that. Okay. But you come up with a reasonable allocation, however they define that, in order to reestablish your basis. Okay. It's irreversible, which means you can only do this once. You can't go back and change your basis again after this. And it applies only to capital assets. And I have heard some people, again, say in response to this, well, if they're actually really going to do this and they're going to start taxing us on all this stuff, then I'm just going to start deducting my utility bills in accordance with holding Bitcoin, my home office costs, and all this kind of stuff. And, kind of delusional takes out there. You can try to do whatever you want. I wouldn't advise any of that because effectively to do that, you'd have to make what's called a Section 475 election, which is a mark-to-market trader election. If you want your crypto activity to not be treated as capital assets, but rather as ordinary trading assets. But you wouldn't want to do that because effectively you have to recognize gain or loss at the end of the year every year. And it's effectively an unrealized capital gains tax that you're signing on for at that point. And you may lose out on long-term capital gains rates if you do that as well. Are these people going to make any kind of Section 475 elections? Probably not. But I'm just saying, if you're a crypto trader, okay, you may want to look into the Section 475 election. Obviously, it's case by case, and there are a lot of things to consider. There's also the significantly higher audit risk if you make that election, because a lot of people make that election kind of frivolously, and then they start deducting a whole bunch of stuff they shouldn't. So it's obviously a hot topic for the IRS to look after people who are, trying to take losses on investments through the trading election, because with capital losses, you can only deduct $3,000 net of capital losses per year. People do this trading election, mark-to-market election, so that they can deduct all of their losses against their other income that they have because they're ordinary losses at that point. Of course, your gains are also ordinary gains, which are typically higher than long-term capital gains rates. So anyways, there's a lot of things to consider with that kind of election. But yeah, you're not going to be able to get away with that. Sorry. Unless you have a Bitcoin mining business, and you're actively in the business of producing Bitcoins. That's the only way that I could see how you could justify that. You have Bitcoins in your office, and you use that office exclusively for mining Bitcoin, and then you could try to do whatever you need to do at that point to deduct associated business expenses. But yeah, you're not typically going to get around that. For most people, your crypto are capital assets. Okay. And you have to do this allocation before January 1st, as I've said a few times. You must maintain sufficient records, identifying the basis basically of each account that you have, the total units of unused basis, and all the stuff, right? Okay. So basically, what this is them throwing away your get out of jail free card at this point, because you understand they audit a lot of people in crypto now. It's one of the big things in what they call the tax gap. It's one of the biggest missing sources of revenue that they feel like they are entitled to. It's in crypto and people not complying with crypto tax law. This is them basically saying, okay, we gave you an opportunity to come clean, come forward, and to establish proper records at this point. We understand that a lot of people did not keep good records in the past. Now, at this point, you have no excuse. And that's why they're calling it the safe harbor, because in their view, they gave you an opportunity to step forward, to orient things properly according to a reasonable basis allocation. And if you don't keep good records moving forward, that's your fault. You get no levity for it. Okay, that's kind of the thought that's going behind this. So Revenue Proc 2428 leaves taxpayers and tax practitioners searching for additional clarity. And they even say in the tax advisor, this is little known guidance. Okay, this is actually from October 29th. I'm making this video December 17th. I didn't even know about this. And evidently, according to my post, most people didn't know about this either. So a lot of these people are not going to make these special allocations in time, as you can imagine. Here's some suggestions. Yeah, they're advocating for using outside software. So yeah, these are good things to know. So let's give a little presentation on kind of how this works. I'm not going to draw 50 wallets of pure Ragnarok, but I'll draw three. Okay, so you've got wallet A. Can you all see that? I don't think so. Oh, that's way too big. Okay. Wallet A, wallet B, and wallet C. Okay. Now, under the old rules, let's say that you had $100 in Bitcoin in this wallet. You had $1,000 of Bitcoin in this wallet, and you had uh, $10,000 of Bitcoin in this wallet. So your basis before these rules under the universal accounting methods would be 10,000, or excuse me, geez Louise, $11,100. That'd be your basis. So it doesn't matter if you sold your Bitcoin from wallet A, wallet B, wallet C. You'd be pulling from this basis. Now, obviously, it's never that simple because you buy like 0.5 here, 0.7 here, and then one Bitcoin here, and you sell maybe like zero point 0.1 Bitcoin. So you have to like take a piece of the basis from like down here, and then you have to use that as your basis for the crypto that you sold at 0.1. Right? It always gets complicated, but that's your universal basis. So they pretend that all of these wallets are basically one wallet, wallet A. Okay. But under these new regs, let's just delete this. Under these new regs, all of these wallets have to have their basis tracked independently, right? So you have A, B, C, 100, 1,000, 10,000. So if you sell $500 of Bitcoin from this wallet, wallet C, okay, this is not going to be touched. It's only going to come from wallet C. So if you sell $500 of Bitcoin and the basis, let's say, of that Bitcoin partition was, let's say, $100, then you would have a $400 gain. Okay. And I don't have the patience to deal with paint to actually spell all this out. But basically, the basis would be calculated from each wallet. Now, here's a little strategy that you can employ. Let's say that you have a cold storage wallet from like 2014, and you've got like a billion Bitcoin in here, right? And the cost basis on this Bitcoin is like super low because you got it in 2014. Your cost basis on the Bitcoin, let's say, is $1,000. Now, under the old rules, because it was first in, first out, you had to recognize the basis in your sold crypto. Let's say it's 2024, and crypto is 100K. Um, you would have to recognize huge amounts of gain because your basis is so low. Because on every Bitcoin, you're recognizing a 99K gain. So if you want to buy more Bitcoin, the strategy is to just leave this wallet alone because here you have the lowest cost basis and therefore you're going to recognize the highest gain. It's best for you to simply just start a new wallet and start having the Bitcoin that you're purchasing very recently go into this new wallet with the 100K cost basis. These are how my accounting worksheets look, by the way. Nothing's in order. 100K cost basis. Okay. So that instead of, uh, recognizing 99K in gain on every Bitcoin that you sell, if it goes up to, let's say, 110,000, you're just recognizing 10K instead of 109K, right? Does that kind of make sense? So there are some like good tax strategies with this as far as like saving your old crypto because it's in a designated wallet in its own universe. Like if you never touch it, you never have to recognize gain on those cryptos in accordance with this new rule. You just have to recognize gain on cryptos in accordance with whatever wallet that you're using. So that's something to consider. So, anyways, that's a little bit of an overview for you there. I hope I'm speaking loud enough into this thing. But one question that somebody had was, well, what if I move? Let's just erase all this. Let's do another example. So they say, well, what if I'm moving between my own wallets? How do I deal with that? Well, we have something called related party rules, which make it so that, let's say you have $1,000 here in Bitcoin, and you're moving it to a wallet that got $0. Okay, very simple. A, B. So you move, let's say $500 to this wallet. Now that's the fair value of the Bitcoin, but the cost basis is $100. So your value has gone up like 5x, right? You have two Bitcoins in here. You're moving one of your Bitcoins to wallet B. Mm, So, how much do you recognize in wallet B? What's your basis? Well, because it's a related party transfer, related party, your basis shifts. And so your basis in wallet B is not $500, but it's $100. Does that kind of make sense? So just very elementary things like that, a lot of people may miss. And typically, when you start to get into basis stuff, whether it's with partnerships and S corps, or whether it's with property and real estate or crypto, even a lot of people then go to tax professionals to figure that out because there are little distinct rules. And getting into gifting property is another kind of complex area that I don't really want to go into. It's not that complicated, but there are some additional basis considerations with that. It's like if you gift when the fair market value is above the basis, that could be treated differently than if the fair market value was below the basis. Um, Different treatments there that you kind of have to look out for. So, um, are most people going to follow this? Is the question, right? Um, and let me know what y'all have considerations about because this is kind of new to me too, and I'm thinking about all the implications of this. Because if you have a lot of different wallets, um, you're gonna have to keep track on all those wallets what your basis is. And if you have a lot of different wallets for different things, that's going to be a lot of paperwork. And it makes the accounting tougher too. It makes business adoption tougher because if you're a business, what would be easiest is to just have one other asset account on your books, on your balance sheet, that has the cost basis of your crypto. Um, but now you're going to have multiple sub accounts of that wallet that represent the cost basis of all the different wallets that you have. And then you have to keep tabs on which transactions are coming out of which wallet so that you can calculate your gains and losses on those respective wallets, which is a total freaking hassle. And I wonder what the 8949 is going to look like, the gain or loss sheet. Are they going to ask for the wallet ID so that they can know that you're figuring basis within a particular wallet? Uh, just questions that I have. I mean, this is only going to get worse, right? I mean, you saw where they wanted to go. I mean, this is the original 1099 DA that we looked at before they had made the adjustments. They wanted your wallet IDs. They wanted all that info. So I think the direction this is going in is obviously more surveillance and more complicated tax uh, compliance. And it fits into the narrative, man. It fits into the narrative. And, a lot of the Bitcoin bros were like, gosh, this is so unfortunate. Why do we have to comply with this? It's like, dude, you guys chose to have the transparent blockchain. You guys chose to dedicate yourself to getting everybody onboarded to this piece of technology, which effectively sells their privacy rights away. I mean, I know a lot of people don't view it that way, but that's effectively what's going on in the macro. You're getting a lot of libertarians to endorse the civilian population in giving up their financial privacy rights for money so that they can try to make money off the government. It's a pretty crazy situation. But that's effectively what's happening. And now you're getting what you paid for. You're going to have the IRS tracking you, law enforcement tracking you. They're going to accuse you of things you didn't do because they very vaguely linked you in with certain activity that maybe you weren't associated with, but their blockchain forensics said you were associated with. And you're going to pay tax on all this stuff, and they're going to track everything you're doing. And I made an argument to somebody. I said, "Hey, well, look, uh, I would like for them to get rid of the capital gains tax on crypto, perhaps more than anybody. But in regards to them doing that, I find it incredibly unlikely. And interestingly, I think the casinos would actually lobby against that because a lot of the crypto world is gambling, right? It is gambling. It is speculation. That's 99% of this space. I would say maybe 1% of all the crypto activity in our space actually comes down to economic useful transactions. Um, they're not going to let you get away with your gambling winnings without tax. It's as simple as they're not going to let you get away with making $100 million on Fartcoin and not pay any tax on that. So their reasoning, of course, is going to be that, well, you have to pay tax on your gambling winnings. Why are we making it so that people don't have to pay tax on their winnings in crypto schemes? Obviously, we need to tax this. And there are so few people actually doing transactions because the whole narrative has shifted from having crypto as a currency to this digital gold crap that the status quo for so-called useful cryptos is to simply hold on to them and not even use them. But it's a safe haven. It's a store of value rather than something that's actually supposed to be used as a currency. And so they don't really have a lot of sympathy for people who want to use this as a currency, even though regs like these make the compliance burn exceedingly difficult if you do want to use these things as currencies. Because either you're gambling, you're speculating, or you're just holding on to something which is effectively gold. And what do you care about the tax implications if you're going to hold it forever anyway? I mean, what do they care? Why should they get rid of the capital gains tax? Is what they're going to be thinking, especially if it brings in a lot of revenue and it allows them to have more of an insight into what people are doing with their money. Because if you have to report all of your transactions basically to the IRS on the premise that you have to pay capital gains tax, then if they get rid of capital gains tax, then they're going to give up that information as well, which helps them track and uh, keep tabs on the population. That's kind of why I think they're not going to get rid of the capital gains tax on crypto. Maybe they'll make an excuse for Bitcoin, in which case Bitcoin will kind of have that um, uh, sanction from the state. It'll be given a special state status. It'll be regulatorily captured. And then at that point, it'll establish an inelastic demand, which actually gives it some kind of store of value in that case. You're going to see a lot of value flow into Bitcoin. But you're also going to see a lot of value flow into Monero, okay, for obvious reasons. Um, obviously, I don't endorse anything. I'm just telling you. And somebody keeps saying on my Twitter, I'm going to give you a shout out because I think you are kind of wise in saying this. but you say, uh, maybe I didn't tweet you out. Your name is Opportunity from Chaos. You have some pretty good takes. Crypto Comic Con. Uh, your take is that the higher Bitcoin goes, the higher Monero goes, because invariably some of that Bitcoin liquidity is going to leak out to Monero, and I think that's right. I think that's right, especially as the walls continue to close in. I think that is right. So, I think that's all I've got to say about this. So, figure out your situation, figure out what you're going to do. Obviously, a lot of people are just simply not going to comply with this, as they've said online. They're like, well, they can't take us all down. But look, man, you don't want to get, well, y'all are independent, sovereign individuals. You go figure it out. But um, this is what is coming down the pike. And these things are only going to get worse, in my opinion. These kinds of things. And so you're going to see a true split between transparent crypto world and the shadow crypto world. And just as a reminder, the so-called shadow crypto world has a total market cap of about $5 billion. And the entire crypto market cap for everything is, I think, almost 4 trillion. So I really don't think people quite understand the value prop here for cryptos like Monero. I really don't know what people are doing. They're missing out on the opportunity of a lifetime to get into secret private money. Truly, money that just doesn't even exist. It's unbelievable. So, uh, anything else I want to say? I think I want to lock this down at this point. Like, what else do I want to say? Yeah, I mean, exchanges are going to become more powerful. You're going to have less and less privacy with these transparent blockchains. It's just the destiny of how this works. Data is profitable. And whatever it is that people can do to establish regulations so as to make that data useful for compliance, the data forensics firms are going to get paid off. The crypto tax compliance firms are going to get paid off. The crypto CPAs, who largely don't even want this, and the lawyers are going to get paid off. A lot of wheels are getting greased with these kinds of regulations, and you can expect regulations because there's so much profit in it, especially for the exchanges as well, because they're going to have a lot of influx of people who are not going to want to deal with the tax consequences of a lot of this. And so the exchanges are going to be happy to just be the provider for that service of tax compliance. And that means more fees on their system and the more powerful that they get. And I'm so skeptical of these centralized exchanges. I'm so skeptical. I mean, I figure if you want to really kill crypto like forever, do whatever you can to goad everybody into these centralized exchanges with their crypto and then just blow them up. Just Mount Gox them, and then it's game over. Right? I mean, just lock up everybody's coins for years because they go bankrupt, right? Then you have to go through bankruptcy proceedings, and you've got like big Wall Street, and then you got all these customers who are clients at these centralized exchanges that just went down. And then at the same time, when these centralized exchanges go down, because Bitcoin has a throughput of about 7 transactions per second on a good day, everybody's Bitcoin gets locked up because the centralized exchanges has effectively become the scaling solutions for these cryptos that really can't scale, but people don't know can't scale because they seem to work just fine on these centralized exchanges, which effectively just move ownership from one person to another without doing any activity on the chain. And so, um, I just have this like really sneaking suspicion that one of these big exchanges is just going to go down, and that's just going to really cause a lot of headache. And maybe that'll be the predecessor to the rollout of the CBDCs. Who knows, right? Who knows? So, real quick, I did want to talk about this super chat that was left for me. Fiat Demise, thank you for the tip. So, the debate between Guy Swan and Steve Patterson. Steve Patterson obviously won that debate on the logic level, but I think he could improve his debating skills a little bit because he came off as a little bit unlikable. Not that that really matters when you're trying to get down to the truth of things, but maybe a little bit of grace could have been given. I know that there's a lot of uh, tension between the Bitcoin Cash communities, the small blockers, and the big blockers, and those kinds of communities. But it could probably have been a little bit more of a cordial debate, in my opinion. But I learned some new things from Steve Patterson, and I have more reason to go read his book. It sounded like Guy Swan on a few occasions didn't quite know how to respond to some of the inquiries of Steve Patterson. Um, they got into some technical stuff that was a little bit beyond me, but basically the argument from Guy was, well, it was good to keep small blocks so that everybody could run a node, and we need as many people to run nodes as possible because that's how we maintain control over the network or something to that effect. And then, or to maintain, everybody's ability to run their own node and have their own sovereignty. And then, the big blocker argument that Steve Patterson put forward was we need to have scaling so that more people could actually effectively use it as money. And uh, basically, you kind of had a break between the store value camp and the medium exchange camp. And the store value bros saw store value as the underpinning of having a decent monetary system upon which you could have scaling solutions and layer twos and medium exchanges that are kind of based on that rock solid, unchangeable layer one, which Steve Patterson poked some holes in by basically saying, well, you all have already altered the code somewhat significantly on a couple of occasions due to inflation bugs and things like that. So if you are willing to change the code for that, why aren't you willing to change the code for other uh, serious instances, such as a lack of scalability? And Guy had said, well, that's an existential problem that we addressed. We had to change the code. And then Steve Patterson said, well, we see it as an existential problem that you couldn't um, have more than 7 transactions per second, and transaction fees were going up to like $50 a transaction back in 2017, and the blockchain was effectively freezing. Some people saw that as an existential problem. So then you get down to kind of subjective definitions as to what's considered existential and what isn't. And so you get into then a kind of vigorous debate that ultimately always goes down to the store of value versus medium exchange debate. And I personally think that Steve made some good points where you could have a medium exchange based on valid code that doesn't really have to change. And well, does he say it doesn't necessarily have to change? I don't know. Go watch the debate. It was like 2.5 hours. I can only think of so much, but I thought it was a good debate. Hijacking Bitcoin's a good book. Um, and I'm generally on the dynamic block size team, which is not the big blocker or the small blocker. We have dynamic blocks in Monero, so they could be small if we don't have a lot of transactions, or they can be big if we have a lot of transactions. You get the best of both worlds, which is great. Okay, so I think that's all I got. I got to get back to work, but appreciate the tip. If you all want to leave a tip again, Monero CPA at XMR chat, and Monero and Zano donation links below. Thank you all so much. Have a good one. God bless.